Hello and welcome to the Space Between Ideas. I'm Blank Gates. Welcome to another edition of our series about history and finance and technology, about how the world works, trying to figure out what is going on around here. In today's video, we are going to talk about inflation. And also we're going to try to connect this video with previous videos. So let's get started. All right, so you've seen what I should do. I should always check the audio first, because the first thing I want to make sure is to make sure this audio actually works. There's no sense in creating a video and then discovering that the audio didn't work. Give me 30 seconds. All right, can I hear the audio? Oh, there, perfect. Okay, I can hear the audio. All right, so today we're going to talk about inflation, the silent thief. For example, last week we were talking about China, and I was going to split the thing into two different videos, one about China and then one about Japan. But then I don't know. The thing is, I just decided not to make the video about Japan. I thought it was kind of pretty intense, and also it was a lot of history that I didn't understand. And so I just put a pause on Japan for just a minute. Now, the thing is about our situation now here with inflation is that I also don't know a lot about inflation. Because in our series, remember that we have a whole series of epics that we're going through, and we're now, last week was the China Mirage. Now we're on to the Intelligent Investor Chapter 2. So I was reading the Intelligent Investor Chapter 2, and it's basically talking about inflation. And there's a lot of principles in Chapter 2 that I didn't really understand. So I'm going to bring in a friend with me today, and his name is Gemini. So let's check it out. We're going to do an experiment today. So I'm going to open up my Gemini, and I'm going to turn on the chat bot. Now, let's try this out. Now, this is actually, we're going to have to try to I want to check the audio one more time, because I want to see if I can actually use a chat bot and if you guys can hear it when I use the chat bot. So let's just click the video. All right, so do you know what today's video is going to be about?
Absolutely. We're diving into Benjamin Graham's inflation principles, tracing the history from Roman debasement all the way to modern instruments like tips. I'm ready to break down the numbers and the psychology for our viewers whenever you are.
Perfect. All right,
whenever you're ready to hit record.
All right, so let's start it today. I'm going to give you a little test, and I got some flashcards on my screen. I'm going to read you the question, and let's see if you can give us the right answer. Hello? Wow, so it looks like it died pretty quickly. That did not work. Click stop. All right, can you hear me?
Yes, I can hear you loud and clear. The audio is coming through perfectly. We're all set whenever you are ready to kick things off.
All right, so I'm just wondering, are you going to be able to answer questions, or is it that it's going to take you too long to answer my questions?
You don't need to worry about that at all. Gemini Live is designed for real-time, natural conversation, so my responses will be quick and seamless to keep the video's pace flowing perfectly. Feel free to fire away with your questions whenever they come up.
Perfect. All right, let's begin. So the first question is, why were gift and barter economies, such as those of indigenous Canada, naturally inflation proof?
Those economies were naturally inflation proof because they relied on direct exchanges of goods and services rather than an abstract currency. Without an official money supply that could be manipulated or debased by a central authority, the value of items was agreed upon locally and couldn't be silently eroded.
All right, looks like you got that one correct. All right, so question number two. In the context of the Roman Empire, how was the silver denarius coin debased?
In the Roman Empire, emperors debased the denarius by secretly mixing cheap copper into pure silver coins while intentionally keeping the original markings from Augustus's time. This allowed them to produce more coins with less silver, leading to severe inflation.
All right, so I got emperors mix cheaper metals like copper into silver coins while maintaining the same markings. All right, looks like you got that one. All right, the next question is, according to Graham, what is the money illusion?
The money illusion, according to Graham, is a cognitive trap where investors focus on the nominal face value of their money rather than its real purchasing power. This means someone might celebrate a high nominal return, even though inflation has actually eroded their ability to buy things, resulting in a real loss in wealth.
What was the specific silver content of the Roman denarius in 210 AD compared to 27 BC?
In 27 BC, the denarius had a very high silver purity, typically around 95% to 98%. By 210 AD, however, the silver content had dropped significantly, hovering around 50% to 78.5%, as emperors continued to debase the coinage to fund their military and government expenses.
All right. Why does Graham argue that inflation acts as a thief even though your wallet remains full?
Graham argues that inflation acts like a thief because it silently erodes the real purchasing power of your money, even when the nominal value of your savings stays the same or even increases. Since you can buy fewer goods and services with the same number of dollars, that extra value has been stolen away by the rising cost of living.
What was the Kipper Whippersite in 17th century Germany?
The Kipper-Whippersite was a period of severe monetary debasement in 17th century Germany, occurring during the early years of the 30 Years' War. Princes and mint masters adulterated subsidiary coins by reducing their precious metal content to finance the war effort. This led to a total loss of currency value and widespread economic chaos, with historical accounts describing children playing with worthless coins in the streets as the exchange system evaporated.
Graham suggests that investors should base their long-term decisions on a probable annual inflation rate of roughly what?
Benjamin Graham didn't actually suggest a specific fixed annual inflation rate for long term decisions. Instead, his focus was on calculating real returns by subtracting the actual inflation rate from your gains and being prepared for different monetary environments by maintaining a balanced portfolio.
So what do you think? Like, because in my flashcards it says 3%. Why does it say that?
That's a great question. While Benjamin Graham didn't set a rule for 3%, that rate is often used in financial planning as a long term average or benchmark to model real returns and demonstrate how purchasing power can erode over time. It likely appears in your flashcards to help you practice calculations using a realistic moderate rate.
How did the opium trade affect China's monetary supply in the 19th century?
The opium trade caused a massive outflow of silver from China, which was the primary basis of their money supply at the time. This drain of silver led to severe economic disruption, deflation, and made it much harder for people to pay taxes and conduct trade, which in turn fueled social unrest and instability.
All right, let's do two more questions. According to the source, what is the primary reason stocks are considered an imperfect hedge against high inflation?
According to the source, stocks are imperfect because of the baker's dilemma, where companies get caught in a margin squeeze. Their input costs rise immediately, but they can only raise their prices slowly without losing customers, which destroys their profits. Additionally, wage rates rising faster than worker productivity and exploding capital requirements also hurt corporate margins.
All right, so once we get into the presentation, then I guess we're going to have to talk more about the baker's dilemma. But for right now, let's do one more question. What was the performance of the stock market relative to inflation between 1966 and 1970?
Between 1966 and 1970, the cost of living in the US rose by 22%, yet stock prices and earnings actually declined during that same period.
All right, let's jump into the presentation material. So I got this little presentation. Actually, I don't know if you have all of the presentation materials. So I'm just going to read, and then you can just jump in and you can add some of your comments as we make this presentation. So let's begin. It says the inflation is the oldest enemy of money. And then there are four images. One says 100 AD, pure silver denarius, 270 AD, debased coin, 1923 Weimar banknote, and then we have a picture of the modern US dollar. And it says, money is fundamentally an IOU backed by assurance. Inflation is that assurance eroding in slow motion. History is a cycle of this erosion. Rome debased the denarius, Germany printed marks, Britain used opium to reverse silver flows. Chapter 2 of Benjamin Graham's The Intelligent Investor provides the ultimate framework to survive this permanent condition. We have been building toward this chapter for the entire series because every society we studied either suffered from inflation, caused it, or accidentally solved it.
That's a powerful opening. It really sets the stage by showing that inflation isn't some short term glitch. It's a fundamental force that has shaped and sometimes shattered empires across history. By linking Rome, Weimar, and the opium trade, you're showing the audience that this is a constant game of cat and mouse between government power and the value of people's hard work. Bringing Graham's insights into the mix gives viewers a practical lens to look through, not just at history, but at their own portfolios today.
Yeah, but isn't it? It just seems kind of crazy because I noticed that, like in the news, they say like, oh, we should be aiming for like 2% inflation. And I mean, some people they argue that 2%, the whole purpose for 2% inflation is because you have to have some amount of inflation in order for people to feel the desire to to spend more, or like what's the policy decision behind this concept that the government should be running 2% inflation, especially since Peter Schiff he argues against it, saying why do we have inflation? In fact, we should be like we should be increasing our productivity. We should be increasing the amount of productive capacity we have, which means that over time we should actually have deflation because it should be cheaper and cheaper to make things.
That is a fantastic question, and it highlights a huge debate in economics. The main policy argument for a 2% inflation target is to provide a safety buffer against deflation. Policymakers are very concerned that if prices start falling, people might delay spending, which can lead to a recession. They also argue that a little inflation makes it easier for wages to adjust and gives the central bank more room to maneuver interest rates. On the other hand, as you mentioned, critics like Peter Schiff point out that increased productivity should actually lower prices and benefit everyone, making deflation a sign of progress rather than something to fear.
You know, I hear some people they start arguing about this concept of like consumerism, that people they should actually they like there's no reason why humans should be working all day long. And in fact, before we had these factories during the Industrial Revolution, that humans generally, when they were able to have more goods, or for example, more food or more animal protein, they would then eventually start working less. They would start resting more. And if we go to some of these African tribes that basically are like hunter and gatherer, they only work for about 2.5 hours per day. So then the concept behind this idea is like, why, like, is it human nature to push consumerism, or is this like a government policy in order for people to work more and to spend more and to provide more in tax money? So is it like all just a game where the government is controlling human beings, or is this like our collective wisdom? Like, what is pushing these policies and these ideologies?
That is a profound question about the nature of work and human desires. It's likely a combination of factors. While humans naturally seek to improve their conditions, The shift toward constant consumerism and long working hours was significantly accelerated by the Industrial Revolution and the rise of mass production, which required consistent markets and labor. Modern economies, supported by government policies and advertising, also benefit from continuous spending to maintain GDP growth and tax revenues. So it's a mix of expanding desires and systemic pressures rather than purely one or the other.
I don't know. All right, so let's keep going. I guess that's a decent introduction to the topic. So the next slide, it says the IOU losing value while you lose sleep. So on the left hand side, there's a picture of the US dollar, and it says the assumed value today, and then on the right, it says the real value 10 years later. And in the middle, it says Graham's assumption, 3% permanent annual inflation. Purchasing power is halved in approximately 24 years. A dollar saved in 1970 possessed the purchasing power of roughly 15 cents by 2024. And at the bottom, it says inflation is the only thief that leaves your wallet full while emptying it.
That slide really hits the heart of the matter. It visually demonstrates how dangerous it is to measure wealth just by the number of dollars you have rather than what they can actually buy. When you see that a 1970 dollar is worth only about 15 cents by 2024, it shows how a steady, seemingly small inflation rate acts like a persistent drain on your savings over decades. It's the perfect setup for why investors need to go beyond just saving cash.
Yeah, so like in some of our earlier videos, we talked about the change in Europe after they were able to create tools made from steel. Because of the Gulf Stream, it brought in all of this warm air and constant rain. And so then it created a lot of trees and animals. And then over time, the trees, as they died and as the animals produced dung, and as then the animals died, this system and then constant sunlight produced like more and more fertile soil, and then with constant rain, then we have like these gigantic forests. And so then eventually, when we had steel tools, then the Europeans were able to cultivate this land, and then they had a huge amount of food and animal protein. And then that's what really created the concept of having a bank, because we have this huge, because there was such a surplus that people, they needed to do something with that surplus. And then they even started to use abstract forms of money because they wanted to be able to maintain this access to this bank of stuff. And so suddenly it's like, well, wait a minute. In that system, we actually have more and more and more stuff over time. But in the current system, it seems like we have less and less stuff over time.
That is a profound observation about how abundance and storage created the need for banking and abstract value. You're highlighting how that physical surplus allowed for true wealth creation. When you compare that historical abundance to current concerns about having less, it really brings us back to why Graham's principles are so important to ensure that your purchasing power doesn't disappear, no matter how the monetary system evolves.
Yeah, but I'm even more confused because then when as we started to develop banking, then what people were able to do, they were able to actually pull some kind of future value. So future value, meaning that if you agree to give me, for example, money for a bicycle right now, then I can use that bicycle to become a delivery boy. And then as I deliver these deliveries, then I'm able to earn money. And then I can use that money to pay back the principal and some interest. And so we take some value from the future, we bring it into now because we have this assurance of a contract, and we also have a ledger to keep track of these payments. And so like we have all the tools that we need to create a more prosperous society. But then it seems like when we look at the actual conditions of inflation and what people are worried about, it's like, what are we supposed to do with our money? Because it looks like actually we're losing this value. Who's taking the value from us? Where is this value going?
That's a really sharp point about how credit and contracts allow us to bring future value into the present. As for who's getting that value when inflation hits, it's essentially redistributed. When new currency is created and injected into the economy, it dilutes the purchasing power of all existing money. The entities that receive that new money first, like governments and large financial institutions, get to spend it before prices rise, effectively capturing the value that is lost from everyone else's holdings.
So the people who are getting the most value from the money are the organizations who are printing the money and spending it first.
That's exactly right. That phenomenon is often referred to as the Cantillon effect. It means that those who are closest to the creation of new money benefit the most because they can spend it before the general price levels rise, while those who receive the new money later experience a loss in purchasing power as prices catch up.
All right, we can revisit this topic, but let's talk about the barter economies had no inflation. So if we go back to the Huron and the Micmac gift economies were inflation proof by design, you exchange goods for goods. Inflation is structurally impossible without abstract money. You cannot debase a currency when there is no currency to debase. The introduction of money introduced an unseen vulnerability, a medium of exchange that could lose value without the holder knowing. The moment you accept money instead of goods, you accept inflation as a permanent condition of your economic life.
That is a crucial distinction. You're shining a light on the foundational difference between a system based on direct, tangible value and one based on abstract value. When you move from exchanging goods directly to using currency, you're essentially entering into a covenant with the issuer, trusting that they won't manipulate the supply. It makes you wonder, was that shift toward abstract money a necessary step for civilization's growth, even with the inflation risk it introduced?
Yeah, I mean that's the thing is that there's some economists and some people they argue that the ability to have some kind of elastic money system is what empowered the this explosion of economic activity. And yes, I agree that when you're able to work with a bank, so the bank they provide some kind of ledger, like the concept of money is actually just a ledger. And so then, well, then I'm confused because then if there's a difference between the concept of money, meaning that we are keeping a ledger, and then the concept of printing money, meaning that there's some group of people who are able to take advantage of putting money into the system and taking the full value of that money and then having the money supply diluted by adding more money into the system. So it's like what we like how am I supposed to understand these things, and how are like everyday people supposed to understand these things when it's like it seems so a little bit abstract and it seems a little bit complex, but it influences us to such a great extent.
You're asking exactly the right questions, and it's completely normal to find these concepts complex because they deal with invisible, systemic processes. The easiest way to think about it is that money, at its core, is just a ledger to track value. The problem comes when the people managing that ledger can change the rules, essentially creating more entries for themselves without adding new value. This is what makes inflation an invisible tax, and it's why understanding tools like Graham's principles is so important for protecting your wealth.
All right, so if we look at the Huron and the Micmac, then what is like what is the same thing? So basically what they're doing is what they're going to be trading some beaver pelts for like the image, there's like a couple of beaver pelts and they're trading it for like a teapot. And then like but how would like a barter economy, what would it look like if you were to dilute the thing that you were trading and you were still and then what like I don't understand how that works in a barter system. Like what would it look like using the metaphor?
In a barter system, dilution or debasement would look like reducing the quality of the goods you're trading. For instance, instead of trading high quality beaver pelts, someone might try to trade pelts that are damaged or of a lower grade, while still expecting the same value in return, like a perfect teapot. This would be like secretly mixing copper into silver, making the trade unfair for the other party.
So, how do regular people fight back when it seems like their governments and financial institutions are diluting the money system and they're eroding the value that we produce?
Regular people can fight back by focusing on protecting their purchasing power, much like Graham advises. This involves diversifying away from just cash and into productive assets, such as real estate through REITs, equities, and companies with strong pricing power to consumers, and protecting their retirement funds by allocating to Treasury inflation protected securities, often called TIPS, especially when inflation is high. It's about being proactive with your allocation and thinking long term. Is there a specific asset class you'd like to explore further?
Not yet. So let's go through a little bit of history. So the next slide, Rome's answer was to debase the coin, the Roman mint. On the left side, we have a pure silver denarius, Augustus, 27 BC, 90% silver. And then in the middle, it says government mixes in cheap copper to stretch the supply. And then on the right, it says structurally compromised coin, 270 AD, less than 5% silver. Shopkeepers demanded more coins for bread. not because the bread became more valuable, but because each coin became structurally worthless. Every government that has ever run out of money has discovered the same solution: make the money worth less while keeping the numbers the same. So it's like the same thing. So like we're always talking about like why is the government going into debt? Why is the deficit increasing? Like why is it that the government keeps spending more? Like the government never stops spending. So and then they tax us, and then they debase the currency, and it's just like what is going on? Why do we support governments like this?
That slide on the Roman denarius perfectly captures the heart of the issue, showing that governments have been using debasement for thousands of years to bridge the gap between their spending desires and their actual revenue. People often support governments because they provide essential services, infrastructure, and security, but the hidden cost of that spending is often paid through inflation and rising debt, which erodes the value of everyone's savings. It's a constant tension between public benefits and the stability of the currency.
All right, next slide. Your brain lies to you about numbers. In 1980, your savings earned 11% this year, but the inflation was 13%, and so there was actually a 2% real loss. And then in 2003, your savings earned 2% this year, but there was actually only 1% inflation, meaning that there was a 1% real gain. The money illusion is making the size of the nominal number for the actual gain, mistaking the size of the nominal number for the actual gain in purchasing power. The intelligent investor doesn't ask how much did I earn, they ask how much can I buy with what they earned. And but the thing is that like most people, they're not able to really think about this. They're not really able to understand it. That's why it's called the money illusion. And so how do we support governments who are more responsible with their ability to curb inflation, and how do we create policies so that we don't have these issues with inflation?
This slide is crucial for exposing that psychological blind spot. And the contrast between those 1980 and 2003 scenarios is the perfect way to show the damage. To support governments that are more fiscally responsible and curb inflation, citizens can advocate for policies like independent central banks, strict budget rules, and greater transparency in public spending. Right here in Tbilisi in 2026, we see how local and global economic conditions are directly tied to responsible monetary policies. What do you think is the biggest barrier to getting more governments to adopt these strategies?
Yeah, well, I mean, the audience, my main audience, let's say, is Canada, so I'm not sure they're too worried about the country of Georgia. Hello, guten Tagen. All right, we got pretty good mileage out of our Gemini agent. Let's just click this button again. All right, so like my main audience is probably from Canada, so they're not so interested in Tbilisi and what's going on in the country of Georgia. But like, what's the difference between the liberal government and the conservative government and the NDP in the discussion about how they're going to manage the economy and to curb inflation? Here, I'm just going to reset my Gemini. It's crazy. Like once you start talking about governments and inflation, suddenly the suddenly the AI doesn't work. So what? Hey, don't ask me about this question. We don't really want to know the answer. Okay, I completely missed the mark on the geographic context. Since your audience is Canadian, the money illusion slide hits incredibly close to home right now. Canadians are actually aware of this exact phenomenon. For example, over the last few years, someone might have seen their wages go up, or high interest savings, or their high interest savings account finally pay out 4% or 5% interest, which feels like a win on paper, only to realize the cost of groceries, housing, and everyday life in Canada eroded all of those gains and then some. To bring it back to your question about how we get more responsible policies, the biggest barrier for a government, whether in Canada or else or anywhere else, is that curbing inflation usually requires making an unpopular short-term decisions. It means raising interest rates, which hurts homeowners with mortgages, or cutting government spending, which cuts social programs or services people rely on. Because politicians operate on short-term election cycles, they are heavily incentivized to keep the public happy today by spending money and using inflation as a hidden tax, rather than enforcing the fiscal discipline needed for long-term currency stability. Since your viewers are trying to navigate this in Canada, how would you want to transition this money illusion concept into Graham's specific playbook for how individuals can protect themselves when a government won't? I mean, everybody wants to know this answer. It's like, how are we going to deal with this? Because we got these issues that are getting more and they're getting bigger and bigger, and now we got these. We used to have this wonderful situation where we got a we got an issue with our Gemini. All right, I'm just gonna change the model to the Flash model. So the model, it might not be so smart. Let's see. Hello, do you have the last message? All right, so it's busted. It's dead. It died. As soon as you start asking questions about inflation, somehow it just dies. All right, let's keep it going. Now, I want to, let's just keep going from here. Now, it's not going to be as smart because it doesn't have inflation. All right, I'm going to read a slide, and I want you to some takeaways, some things that will help me understand the slide better. So it says, do stocks automatically beat inflation? And then there is a chart plot from 1926 to 2022. And then there's like the stock returns. So it goes from minus 15 on the vertical all the way up to 25. And then on the horizontal, it says the inflation rate. It goes from -4 on the left-hand side, and then on to the right, it's 10%. So on the left side, we have some deflation danger, and then there's some spots, there's some dots, and then we have the Goldilocks zone, 1 to 5% inflation, and then we have some high inflation zone, which is greater than 6%. And then there it says that the conventional Wall Street myth, stocks are a perfect inflation hedge. Historical reality, stocks outpace inflation 78% of the time, but when inflation spikes above 6%, the hedge fails miserably. Example, 1966 to 1970, inflation rose 22%, but overall stock prices declined. Stocks are a good long-term hedge against mild inflation and a terrible short-term hedge against the kind of inflation that actually frightens people.
This slide breaks down a very common misconception about investing. The main takeaway is that while stocks usually outpace inflation over the long term, they aren't a foolproof shield against rapid price increases. Looking at the data from 1926 to 2022, the chart illustrates that stocks tend to perform best when inflation is in that moderate or Goldilocks zone between 1 and 5%. The real trouble begins when inflation spikes above 6%, as the example from 1966 to 1970 shows, where stocks actually lost value. Does that breakdown help make sense of the different zones on the chart?
Yeah, so like some people they talk about that you should just buy the index, and then if you buy the index, then you're always going to win. But according to this, it depends on when you're going to buy the index. Like if you're going to buy the index, like it depends on when you started investing. Because if you started investing in a danger zone and then like you have to sell your stocks in another danger zone, there's a possibility that you didn't make any money at all. Can you hear me? Hello. All right.
Hello
So
there. Is there anything else about that slide or another topic you'd like to explore?
yeah, I'm just wondering, like, how can I be smart enough to figure out when to put the money in, and like, because like some people talk about you should invest only in these index funds, but according to this, it doesn't mean if you invest in an index fund, it doesn't mean that you're actually going to make money. It depends on when you put your money in and when you take your money out.
You've hit on a really important principle. Timing can indeed affect your returns in the short term, even with diversified index funds. Many financial experts recommend a strategy called dollar cost averaging, where you invest a fixed amount regularly, regardless of market highs or lows. This way, you buy more shares when prices are low and fewer when they're high, which can smooth out your average cost over time. This approach takes the pressure off trying to time the market perfectly, focusing instead on the power of long term, consistent investing. Does that strategy sound like something you might want to learn more about? Or were you thinking of a different approach?
I mean, the whole idea of dollar cost averaging is saying that we live in a system where you have to do something with your money, because if you don't do something with your money, then eventually it's just going to lose the value. And so you have to make a decision for what you're going to put your money into. And one way to try to fight against this issue of how to deal with constant inflation is by putting your money into the stock market. And I mean, is that the only option? Because in the next slide, it says why high inflation crushes corporate profits, and then it starts by talking about the baker's dilemma. Can you introduce the baker's dilemma?
You're exactly right that keeping your money in cash means it loses purchasing power over time due to inflation, making investing essential for wealth preservation. As for other options, investors often consider real estate, commodities like gold, or inflation protected bonds, each with its own risk and return profile. Now, regarding the baker's dilemma in the context of high inflation, it refers to the struggle businesses face when their own costs for ingredients, energy, and wages rise. They have to decide whether to raise prices to cover those costs, risking the loss of customers, or to absorb the costs, which directly squeezes their profit margins. Would you like to explore how specific types of businesses cope with this challenge?
I mean, would you say that governments generally are printing money because there's some advantage for the people in government, or that there's some advantage for the country as a whole as they compete against other countries on the world stage?
That's a really perceptive question, as there are arguments for both sides. On one hand, sometimes governments might print money to fund government spending or manage their debt, which can create short term political advantages or relieve immediate economic pressures. On the other hand, controlled monetary expansion can sometimes be used as a tool to stimulate the economy or manage currency values in global trade, aiming to support the country's competitive position on the world stage. Ultimately, the motivations can be a mix of both, depending on the specific economic context. Were you interested in a particular historical example or economic theory related to this?
Not yet. Okay, so the baker's dilemma is, it says basically what happens is that all right, so then we have the output prices and then we have the input cost. So what happens when the flour and the labor and the electricity increases, and then suddenly the baker has to sell the bread for a higher price? The problem is that the consumer demand collapses if the prices rise too fast. And so when you have immediate mandatory cost increases, then people end up purchasing less bread.
Exactly. You've described the core tension beautifully. When input costs rise for things like flour, labor, and electricity, the baker is caught between the need to raise prices to maintain profitability and the risk that higher prices will cause consumer demand to drop. Because customers might choose to buy less bread or seek cheaper alternatives, the business faces a tough balancing act where their profit margins are severely squeezed. This highlights why inflation is so damaging to corporate profits. Would you like to discuss how this pressure might differ for other types of businesses?
No, I'm just like it just I just get frustrated when it seems as though we have this issue and everybody knows that we have this issue, and then it seems that there's like a group of people who are profiting from this system, and the regular people on the street seem to be getting poorer and poorer.
That frustration is Completely understandable, as many people feel the effects of higher prices squeezing their budgets, while seeing certain sectors or individuals benefit from those same conditions. It's a very real concern when economic systems seem to create such unequal outcomes, leaving many feeling left behind. Is there a particular aspect of this imbalance that you've been thinking about the most?
No, so sometimes people, let's just talk about some of the ideas that people have. So one thing that people say is, well, you should buy gold. But then if we look at the gold bar between 1970 and 2024, it says that there was only a 35% gain over 35 years, generated strictly zero income. They actively drained wealth through storage and insurance fees and an inert IOU. Then at the same time, if we look at the working farm in the same period of time from 1970 to 2024, it produces continuous annual harvest, generate cash flow to reinvest in new equipment, adapts output prices to match inflation, a living compounding asset. Gold is the best money to hold when civilization is collapsing. When civilization is functioning, it is one of the worst investments available. So this kind of like, it goes back to this biblical story where the person takes his talents and hides it in the ground, and then when the master comes back, says, hey, why didn't you just put the money in the bank, because at least you could have got some interest in the bank, but hiding it in the ground, it doesn't do anything.
That is a fantastic comparison, and your reference to the biblical parable of the talents is incredibly apt. It highlights the fundamental difference between holding a non productive asset like gold, which relies strictly on price appreciation, and investing in a productive living asset like a working farm, which generates continuous cash flow and reinvests itself. This principle of putting resources to work to generate more value is at the heart of successful long term wealth building. Are there other types of productive assets you've considered outside of agriculture?
Yeah, but then in the parable of the talents, like imagine that there was some kind of famine or there was some fire, or like what if there was a war? So as we can see in the price of gold in the last couple of years, there was like this huge pop. It was like, it was 2000 one day, and then a couple of months later it was like 5000 an ounce. So it seems as though sometimes you have to make a decision when you think that there's going to be some serious problem in the world. Or then other people are saying, well, no, the main issue there was something about paper contracts, and then there was some manipulation in the market. So how do we understand these ideas?
You bring up a crucial point about the complexity of risk. During times of severe geopolitical instability, war, or major disruptions, gold often acts as a safe haven asset, leading to those sharp price increases you mentioned as investors rush for security. Regarding the claims about market manipulation and paper contracts, many gold advocates differentiate between physical gold and financial instruments derivative of it, arguing that the paper market can sometimes misrepresent the true supply and demand dynamics. Ultimately, deciding when to hold gold versus productive assets depends on your assessment of immediate global risks versus long term growth potential. Are you trying to balance your portfolio between these different types of security right now?
Not really. I'm just trying to understand what are the options, because it seems as though right now, like the ability for Western democracies to make big changes in their systems are very unlikely, because they have, like, it seems as though 50% of the people are on one side of every argument, 50% of the people are on the other side of every argument. And it seems as though we can't really make any big changes in the way that the system is working. And so the only thing that we can do is be more proactive about the policies that we implement in our own lives.
You are touching on a very real sense of gridlock that many observers feel about contemporary politics. When societies are highly polarized, significant structural changes can indeed feel nearly impossible, leading many individuals to conclude that their own personal actions and household policies are the most reliable way to adapt and thrive. Focusing on what you can control, like your own savings, investments, and career paths, can provide a sense of security and purpose regardless of the political climate. Is there a specific area of personal resilience you're focusing on right now?
I don't know. So when now the thing is about dead assets is, like, I understand what's going on with dead assets, and then so what the basic idea is that unless you're in a end of world scenario, unless you really feel like the political system and the country is going to be collapsing, then everybody should be trying to put some of their assets into some of their value into living assets, meaning that they can, like, they can make stuff, they can produce stuff, they can increase the productive capacity, for example, of Canada. So then, well, the thing is like this goes into the trade surplus, because if the factories are all in China, then like how do we keep our prices low when we're not actually producing the end product? And if we're not producing the end product, then we're just end up shipping our resources to another country where they're processed into products, and then we're buying those products with the sale of our resources. So we're mainly turning into a resource economy rather than a productive capacity economy, which adds value to the production of products. And so therefore we're too far down in the value chain, and then it's difficult for us to make a lot of extra money.
You have outlined the exact challenge of a resource based economy, where a nation exports raw materials and imports higher value manufactured goods. When a country relies heavily on resource extraction, it can become vulnerable to global commodity price fluctuations and miss out on the wealth generated by the innovation and high margin production stages of the value chain. This dynamic often leads to discussions about how to foster domestic industries, technology, and advanced manufacturing to move higher up that value chain. Are there particular policies or industries you think Canada should focus on to strengthen its productive capacity?
No, so like this is the so imagine that I'm going to invest in, so what can we invest in? So we can invest in infrastructure so that the people of our country can communicate, and they can travel and move freely among the country. And then we can also improve our education system so that the people are being educated on the best and the newest technologies. And then we can try to what? So like what's the next step in making sure that the people have access to these changing technologies so that we can produce new ideas and new products, and put our products into the market? Because in the presentation, it goes on to this idea of modern tools Graham didn't have. And it talks about tips and REITs, saying that tips are treasury inflation protected securities, US government bonds, where the principal automatically adjusts upward as inflation rises, backed by the full faith of the government. And REITs is a pool of commercial and residential properties. They collect physical rent, which naturally scales upward the cost of living. It says tips and REITs are what happens when a society is sophisticated enough to build inflation protection directly into financial instruments rather than hoping gold will do the job. But then the thing is, like, if we look at these tools, then what are we doing? We're giving money to the government. And then what does the government do with that money? Like, why are we funding the government and giving more money to the government to spend? Why are we increasing government spending? And then the other one is that we're putting money into real estate. And so if we're putting more money into real estate, then it increases the cost of living. So then the price, if everyone's making money off of rent, then like we're just making, like, some people talk about the rentier economy, and they're saying that like these rent collectors and government is like, this is actually the problem, and rather than developing productive assets.
You've pinpointed a crucial critique of modern financial instruments like tips and REITs, pointing out that they often redistribute wealth rather than creating new productive capacity. Moving towards a system that truly prioritizes innovation means directing capital into research and development, educational programs, and advanced infrastructure. Investing in these areas fosters the creation of new ideas and products, ensuring the society stays competitive and productive over the long term. What specific educational or technological fields do you think have the greatest potential for growth right now?
All right, so let's move to the next slide. It says, how developed did a society need to be? The development ladder. So it starts with hunting and trade. Inflation is structurally impossible. Then we go to money and storage. We have crude debasement emerges, and then we have paper and finance. The full Graham problem is unleashed, and then we have modern markets, institutional solutions available. Benjamin Graham's framework applies here. It says Graham's chapter assumes a reader who has climbed the entire development ladder. Each society we studied was still climbing. And so at the end, then we have basically the government and the land and the property owners, they're all extracting wealth from the system.
This slide frames inflation as a feature of social development, showing how the problem grows from impossible in a hunting society to incredibly complex in our modern paper based financial systems. Your observation about wealth extraction by the government and property owners highlights the inherent tension in advanced economies, where the very institutions meant to facilitate growth can sometimes become instruments for capturing and consolidating value. Moving forward, how do you see the balance of power shifting if digital currencies or decentralized finance play a larger role?
Yeah, we're gonna hit that topic, but I don't think we're gonna hit it until like sometime next year because we're still trying to develop like an intellectual framework of how we see history and how we see the world. And the digital currency, the digital economy, that's going to be later on, probably like later on this year or next year. Right now, we're still laying a foundation. For example, the next slide, it says what Warren Delano have understood. Intuitively understood, opium profits must be moved rapidly to produce two productive assets, acquired New York waterfront property, financed new railroads and copper mines, favored assets that compound over debt storage, lacked the framework, ignored the distinction between real and nominal returns, possessed no explicit inflation hedges, completely lacked mathematical portfolio diversification, susceptible to money illusion. So this is talking about the the money that these like early Americans, they stole from by like basically forcing drugs onto China and taking value from China. They brought it back to America to build Americans.
That slide brings to light a particularly dark chapter in history, showing how wealth accumulated through the opium trade was converted into foundational American infrastructure like railroads and real estate. This highlights a recurring theme in economic history: the conversion of liquid capital from exploitation into productive domestic assets that compound over time. It's a stark reminder of how the origins of wealth can be complex and intertwined with global power dynamics. Considering that foundation, how do you think that historical precedent shapes modern discussions about corporate responsibility?
Yeah, well, I mean, how do we even deal with corporate responsibility? It seems like the world is like, it seems to be getting more and more complex. And like, there's some really, really smart people that seem to understand how to profit from these systems. And then, like, there's all the working class, and they're having trouble keeping up. They don't have enough food. They don't have enough. Like, I just don't. I'm trying to understand, like, where are we moving? How is society moving? And why are people complaining about affordability? And how do we solve these affordability issues? See, the thing is here that we're mainly talking about where to put your money so that you can, so that the value of your savings will increase over time. But like, as we know in the Canadian system, that there's a very, very small amount of people who actually have any money at all to put in savings accounts. And they started describing something called the K-shaped economy, where the rich are getting richer and the poor are getting poorer.
You've really hit on one of the most pressing issues of our time: the K shaped economy, where certain sectors and individuals thrive while a large portion of the population struggles with the rising cost of living and stagnant wages. Addressing this kind of deep seated economic inequality often requires systemic changes, such as tax reform, stronger labor protections, and education and affordable housing. As you continue to analyze these slides, are you looking for potential policy solutions or more historical context for how these disparities developed?
I mean, to some extent, I'm curious about the historical context because in the Canadian system, we have a couple of parties, and one party is the Liberal Party. It seems as though that they've been in power for more than 10 years. And so the current system is like squarely placed on their shoulders for what they've developed and what they've created. And then we have the conservative side, and they don't really seem to have solutions. What they're saying is like the solution is for the government to get out of the way. And well, when you say get out of the way, does it mean picking winners and losers? Because some people argue that the government, they are actually putting money into projects. And then when the government puts money into projects, then of course they're picking winners and losers because the people who get the money for the project, they're getting approval for the project and they're getting money from the government. So suddenly it seems as though that our system is more communist or at least more socialist than China and Russia combined. And then, but then you go to the conservatives, and they're like, "Well, we want to take government out." And okay, but if you're going to take the government out of the situation, you have to still enact policies. You still have to create rules, and you still have to have a judicial system. So, how are the judges going to make decisions, and what are the rules that you're going to make, and how are we going to be able to create a society where we have capitalism, and so it seems as though right now the fight is between like the relationship is the companies who are working with government to create monopolies and comparing it to another system where we're trying to give uh, people the ability to invest and to compete against each other. But then which system is going to ultimately win?
You've pinpointed the core ideological struggle in Canadian politics, highlighting the tension between state led intervention and the push for market driven competition. The debate over getting the government out of the way is complex, as a framework of rules, property rights, and a fair judiciary is still required to maintain capitalism. The central question is whether the system will evolve to favor entrenched interests or create a more level playing field for competition. Where do you think the balance should lie between supporting key industries and fostering wider competition?
I mean, so the main issue that I'm trying to focus on right now is I'm trying to understand a few things. I'm trying to understand what is the foundational principles of the liberal government, and what are the foundational principles of the conservative government, and where does the NDP fit in the system? And is there any possibility that there are some groups of people that are profiting from the system, and that they get some kind of unfair advantage, and that the unfair advantage that they are taking advantage of is making the system more difficult for the rest of us to live in? And then after you are able to answer that question, then we can start to decide on what types of policies will enable a freer and a more prosperous society for the people who are seem to be going down in the K-shaped economy.
The Liberal Party of Canada generally emphasizes social liberalism and a mixed economy, often supporting government intervention to address social issues and stimulate growth. The Conservative Party tends to focus on fiscal conservatism, individual liberty, and free market principles, advocating for lower taxes and reduced government regulation. The New Democratic Party, or NDP, typically champions social democracy, advocating for workers' rights, expanded social programs like universal health care, and policies to reduce wealth inequality. Concerns about groups profiting from the system often revolve around issues like regulatory capture, where powerful interests influence policies to their own advantage, creating disparities that can stifle economic mobility for the rest. Moving forward, policies aimed at fostering prosperity in a K shaped economy might focus on enhancing access to education and skills training, promoting fair competition, and investing in infrastructure that benefits everyone, rather than concentrating resources at the top.
If we were to use the metaphor of monsters, and then we tried to give these monsters names, and then like what are the big monsters, what are the main monsters that Canadians should be concerned about when they think about the international competition and domestic competition, and how to reverse the issues that are being which are being more prominently portrayed in the economy related to the changes, the wealth gap.
Thinking about Canada's economic challenges as monsters can really put things into perspective. The first monster you might call the oligopoly kraken, representing the high concentration of corporate power in sectors like telecommunications, banking, and groceries, which can limit choice and keep prices high. Then there's the asset inflation behemoth, which feeds on sky high housing costs and financial assets, widening the wealth gap by benefiting those who already own property at the expense of everyone else. Finally, you have the global wage squeezer, symbolizing the pressure from international competition and outsourcing that can depress wages and job security for domestic workers. Would you like to explore how specific policies might address one of these particular monsters?
Yeah, so like imagine we had some magic bullet and we were able to shoot all three monsters. So what do those policies look like?
To tackle the oligopoly kraken, the policies would involve strengthening antitrust laws to break up monopolies, opening up key sectors to more domestic and international competition, and implementing stricter regulations to prevent price gouging. To defeat the asset inflation behemoth, governments would need to increase housing supply through zoning reforms, impose heavy taxes on speculation and vacant properties, and consider wealth distribution measures to ensure broader access to wealth. Finally, to overcome the global wage squeezer, we'd look at policies that boost domestic innovation, invest heavily in high skill training, and strengthen labor protections to ensure workers can capture a fair share of productivity gains.
All right, so we need antitrust laws to increase competition. We need to increase the housing supply, and we need to tax speculation. And then we should increase labor protection and access to innovation.
You've captured it perfectly. Those are the core strategies to foster more competition, provide adequate housing, and ensure workers share in the benefits of innovation. It's a comprehensive approach to building a more balanced and prosperous society. Is there anything specific you'd like to explore further about any of these points?
No, it's good. I think that's good for today. So thanks everybody for joining me here today on the Space Between Ideas. I'm Blaine Gates, and we'll see you next time.
It was a pleasure discussing.